Hi, before this video you should already understand the words and concepts found in financial statements. So these financial statements are the balance sheet and the income statement. So the topic for this video is financial ratio analysis with a focus on the current ratio. Remember, you can always go back to mbabullshit.com. Alright, so let's get down to it. Now, this video discusses and analyzes the current ratio, which is one of my free videos on liquidity and profitability ratios. And this includes liquidity, profitability, and market value ratios, which include these ratios over here. Okay. And after this, you can check out my next videos on mbabullshit.com, such as my financial leverage ratio critical analysis video, which includes these ratios over here. And after that, or at the same time as that, or even before that, you can also check out my other video on financial ratios with a focus on turnover ratios critical analysis, and that includes these ratios over here. Alright, so let's get down to it. So let's start with the story. Let's say that ABC Company has $1,000 in current assets, not $1,000 in assets, $1,000 in current assets, and $800 in current liabilities. Now, just a reminder, what are current assets and liabilities? These are assets or liabilities which are convertible or which will turn into cash within the next 12 months. So if it's a current liability, it is due within, or needs to be paid within the next 12 months. Current assets are assets which you can easily convert into cash within the next 12 months. So now, what is the current ratio? Well, it's very simple. Current ratio is $1,000 divided by $800. Where did we get this? $1,000 is the $1,000 in current assets, and the $800 is the $800 in current liabilities. And the current ratio is 1.25. Now, the more important thing is, now this is very easy to compute. So the more important thing is, what does this mean? What does 1.25 mean with the current ratio? Well, it means that the company has 1.25 times the amount of current assets to pay for its current liabilities. Or another easier way to understand it, if you don't understand the meaning of 1.25 times, is that the company has an excess of 25% in current assets to pay for its current liabilities. It has more than enough current assets to pay for its current liabilities. As you can see here, these current assets can be used to pay for the current liabilities. Current assets pay for the current liabilities over here. And they have an excess of 25%. So they have 25% more in current assets to pay for its current liabilities. So this indicates that the company will not, now I stress the word indicates because it's not 100% sure. So this indicates that the company will not have any trouble paying its debt for the next 12 months. The current assets are more than the current liabilities for the next 12 months. How much more? 25% more. So, if the current ratio is higher than 1, why is this good? Well, it's good for creditors. Example, banks which loan them money, which need to be paid back within the next 12 months. If the current ratio is less than 1, that means negative net working capital. Therefore, I like to use the word threshold. The current ratio of 1.0 is the threshold, meaning this company is in trouble if the current ratio is less than 1.0, because then that means that there's not enough money to pay for its current, or not enough assets to pay for its current liabilities. Now, you might think that this is good, right? Oh, current ratio is higher than 1. But if your current ratio is higher than 1, or not even higher than 1, if your current ratio is high, it can also be bad. Why is it bad? It may indicate inefficiency in using short-term assets. Now, what do we mean by this? Well, just imagine that you are a stockholder or a shareholder or an owner. You will want ABC company to earn you a profit while using as little assets as reasonably possible, right? Because if there are excess assets, like in our example, there's a there's an excess of 25% of current assets. If there are excess assets, you'll want ABC company to either give you back that excess asset, these excess assets to you as the owner, because the company isn't using it anyway. Or you would want the company to invest the excess assets in other projects, etc., to earn more profit. Okay? So a higher current ratio is not always good. It is only good for creditors. For owners, it is not necessarily good. I'm not saying it's bad, but well, it can be bad. Okay, it can be bad. But as you can see, it's more complicated than just saying that the current ratio is better when it's high or low. Okay, now the opposite is also true. If the current ratio is lower than 1, why can this be bad? Well, it's bad for creditors because the bank because then that means that they cannot pay back their creditors, or they might not be able to pay back their creditors within the next 12 months. But if it's lower than 1, can it also be good? Well, not necessarily. I think a better word than lower than 1 is if the current ratio is lower, okay, maybe not necessarily lower than 1. If the current ratio is lower, why is this good? It might indicate efficiency in using short-term assets. Okay, why? If you are a stockholder or a shareholder, you will want ABC company to earn you a profit using as little assets as reasonably possible. Okay, so that's it. Now, what are the flaws in using this ratio? Well, let's look at flaw number 1. First, a high current ratio may give a false sense of security to creditors by treating all current assets and current liabilities equally. Now, what do I mean? Well, let's look at an example. Let's say your company has little cash or zero cash, but has current assets, okay? In current assets, let's say that your company has accounts receivable worth $105, which will be collected in the next 11 months. So this is still a current asset because it's less than 12 months, right? But at the same time, your company has current liabilities in the form of accounts payable of only $23, which is much less than $105. But this needs to be paid next month, 1 month from now. Okay? Well, if you do this, if you try to find the current ratio, you'll find that your current ratio is an ultra healthy 4.57. It's way higher than 1, than the threshold of 1. So this indicates that your company is very healthy. But actually, as you can see, next month this company will be toast. Why? Well, you have a very high current ratio because you have more than enough current assets to pay for your current liabilities. But these current assets will be turned into cash 11 months from now, which will be too late to pay for these current liabilities next month. So your company will be toast, okay? Your company will have a cash flow problem and it will not be able to pay its debts, even if your current ratio is an ultra healthy 4.57. Okay? So that's it. Now, what's the second flaw of using this ratio? A low current ratio, remember, a low current ratio supposedly means that your company is at risk. a low current ratio may give a false sense of danger. Let's look at an example. Let's say your company has little or no or zero cash, but has accounts receivable of $105 as your current assets and current liabilities in the form of accounts payable of $100. So it looks like this company has a dangerously low current ratio of 1.05. So it's just a little bit above the 1.0 threshold. And so this indicates that your company could be toast, could get burned very soon or very easily. But what if your company has a huge and ready line of credit from banks, meaning that your company has a contract arrangement with banks that anytime you need cash, a big amount of cash, the bank will automatically lend it to you in case you need it. So in this case, you will not necessarily be toast because you can always borrow the cash to pay for current liabilities. Okay? So that's what it means. Now, how do we analyze this ratio? Well, in finance, the two traditional ways of using financial ratios is using what we call time series analysis or historical analysis and comparison to the industry. So the first one is to compare your financial ratio to the historical compare your current ratio, your current ratio now, to the historical current ratios of your company. If your current ratio is higher now than last year's, then either you're in a more stable or less risky debt situation than before, or it could mean that you're more inefficient now than before in managing assets. Okay, remember I said a high current ratio can indicate inefficiency because you're using too much assets. Okay, or it could be both of the above. If your current ratio is lower now than last year's, then either you're in a more risky debt situation than before, or you're more efficient now than before in managing assets, or both of the above. And the traditional analysis number 2 is to compare your current ratio to that of companies in similar industry. I'd like to stress similar industry because it's normal for companies from different industries to have different current ratios. Okay? Very different current ratio. So if your current ratio is higher than similar companies, then either you're in a more stable or risky debt situation than them, or it could also mean that you're more inefficient than them in managing assets, or both of the above. If your current ratio is lower than similar companies, then either you're in a more risky debt situation than them, or you're more efficient than them in managing assets, or both of the above. Okay, so simple as that. So there you have it. Now, why do I say similar industry? For example, a bank would have a lot of current debt. Why? Because they have a lot of depositors. They have a lot of depositors, and deposits are considered debt, right? But certain companies, like, I don't know, a school, for example, a university might not have. Well, I don't know nowadays with all these overpaid PhD doctors who are famous and stuff. I don't know. But certain businesses, on the other hand, do not have much debt, and so therefore they would have a much should I say a much more conservative current ratio, or a current ratio which looks much more conservative or less risky. Alright, but actually, like I said, it doesn't matter. What matters more is comparing your current ratio, the current ratio of your company or of one company, to current ratios of other companies in similar industries. Okay, we do not normally compare the current ratios of two different companies in different industries. Alright, so there you have it. Please share it if you like it, or share us if you like us on Twitter, Just look for NBA Bullshit on Facebook. On Facebook, just go to facebook.com/NBA Bullshit, or forward our YouTube links on your email. Have a great day and goodbye.